So there are different models through which we can evaluate the stock. One is the dividend discount model, and which can be used for the companies which are paying dividends, and we find the present value of these future dividends and add them together to find the price of the stock of such companies. Then the other model is a residual income model. If the company is not paying dividend but it has positive earnings, we can use that to find the price of the stock as well. Now, what about those companies which are not paying dividend, and also at the same time it seems that they have a negative earning? Their earnings are not positive. Uh, Such companies, again, their stocks get traded on the stock market, and normally there is some price attached to those stocks. So the important thing to remember over here is this, that the earnings can be negative, but the cash flows can be positive. So being a stock analyst, we try to find the price of the stock of such companies from their positive cash flows. And how is it possible that the earning is negative and the cash flow is positive? The issue is this, that we know there are accounting rules based on which we can generate a negative earning, but still the companies are generating the cash flows. So pause over here and think what could be such items which reduces the earning and to the or brings the earning into the negative zone, but at the same time there are positive cash flows. So one important such item is depreciation. So depreciation reduces the earnings and even can bring your uh, earnings into the negative zone, but at the same time there could be positive cash flows. Why is it so? Because depreciation is a non-cash based expense. The benefit to the company of depreciation is this, that it decreases the expenses. So the main thing is this, that it lowers the taxes, because depreciation is such an expense that is tax deductible. So whatever you are paying, it will lower down your taxable income, and thus you have to pay lower taxes. So there are actually more complex things to think about in order to find. There are so many adjustment stock analyst needs to do to find a pure value of the free cash flow. Free cash flow means that cash flow which can be used to pay off both the the claims of the debt holders, and it can be also be paid to pay to the equity holders. So free cash flows needs a lot more adjustments, but usually the stock analysts come up with this simple formula to find the free cash flow. So they multiply the earning before interest and tax with 1 minus tax rate. So whatever is the tax rate, they multiply the earnings before interest and tax and subtract it from the earnings before interest and interest and tax. Over here you can see the first item over here in the equation on the right side. Then they add the depreciation back, because depreciation do not decrease the cash flow. From there, we subtract the capital spending. So whatever is the capital expenditure, obviously, the capital expenditure decreases the cash flows. So whatever is the cash flow, it basically burns that cash. If there is a capital expenditure, you have to buy uh, a big asset which might be there for a very long period of time. It keep generating the income, or that asset will be utilized beyond one period of time. Such asset is actually a capital, and towards that, whatever you are spending, that is your capital expenditure. So capital spending, you decrease it, and then change in net working capital, the increase, the difference between the current assets and the current liabilities. The difference between the current asset and current liabilities is the net working capital, and if it increase, it commits the firm's cash to pay off that extra net that extra current asset which now you need to buy. because when it is increasing, your net working capital increasing, it means that current liability did not increase, but or might have decreased, but the current asset increased at a faster pace. So in order to buy that extra current asset, now the company needs to commit their cash. So it reduce also the cash. So the free cash flow will decrease. So we can see that it is possible that the net income can be negative, but at the same time, free cash flow can be more than zero. It's positive. And main item over here is depreciation. And depreciation and capital spending matters in the free cash flow. Now let's do the comparison between the dividend discount model and the free cash flow model. The dividend discount model, we actually accounting for the cash flows which pertains to the equity holders, which is dividend. The dividend goes to the equity holders, and we try to find the present value of all the future cash flows, which is dividend, and find that what is the price of the stock, right? So dividend discount model uses dividend, a cash flow only to the equity holders, right? And while doing the dividend discount model, we use the discount rate, and that discount rate is calculated through the capital asset pricing model. And in that capital asset pricing model, we use the beta. Usually, when we talk about the beta, it's the equity beta. And on the Yahoo Finance side, we can see that we have this number over here. For example, for the Walmart, on Yahoo Finance side, on the summary page, we have the beta over here, 0.131, suggesting a very low beta and low risky company compared to the beta of the market, because the beta of the market is 1. So anything below 1 is relatively less risky compared to the market itself. Now, we use equity beta in order to find the stock of the price of the stock when we are calculating the price using the dividend discount model. When we come to the free cash flow model, we talk about again the cash, but this is a free cash flow, and it can be used to pay both to the debt holder and the stockholder, unlike dividend discount model, where the dividend is only used to pay to the stockholders and not to the debt holders. So we can still find the value of the equity using free cash flow, but first, when we are doing the calculation, we find the value of the whole firm, and from the value of that whole firm, we subtract the value of the debt and compute the value of the equity. In case of dividend discount model, we directly compute the value of the equity, but not the whole firm. So in free cash model, we find the value of the whole firm, and then from there, we subtract the value of the debt to find the value of the equity. So there are 2 steps in free cash flow model, but in dividend discount model, there is this is not the other step is missing. We do not subtract the value of the debt because we directly find the value of the equity in dividend discount model, unlike the case with the free cash flow model. Now, rather the discount rate which we use in the free cash flow model, it is computed based on the capital asset pricing model. But in that capital asset pricing model, the beta which we are using is not the equity beta. So it's not this beta which is directly given on the Yahoo Finance side or any other beta given to you, not this one. There is a little bit of adjustment we do, and we compute from the equity beta, we compute the beta of the assets. So we find the asset beta rather the equity beta, and the asset beta measures the risk of the industry to which the company belongs. So if there are 2 companies in the same industry, they usually have the same asset beta, but the equity beta can be different. So the equity beta depends on the debt which the company are using. When the company is using more debt, the things get more risky for the equity holder. So higher the equity usually is associated with the higher equity beta, um, equity beta, which is suggesting that the company is more risky for the equity holder, where there are more debt present in the company. So here we can see that asset beta measures the risk of the company's industry. Firms in the same industry, should have about same asset beta, and their equity beta can still be different because it depends mostly on the debt present in the company. If there is more debt, that company is more risky for its equity holders. We can find the asset beta from the equity beta, and here is the formula. So if you have the debt of the company given to you and total equity given to you and the tax rate, this T is the tax rate, and you have the equity beta, you will know that if in the equation we have all the variables given to us and one is missing, we can easily find that the value of that variable. So over here, the asset beta we can find by remanipulating this equation. Now the question is, what happens if the firm has no debt? Just pause the video over here and think about it. Yes, you are right. In this situation, if there is no debt, then obviously this becomes zero, this, and this whole thing become equal to zero, this one, right? So 1 plus 0 equal to 1, 1 multiplied by asset beta, which will be equal to equity beta. So the asset beta and equity beta is same for a company which does not have any debt. Now, in free cash flow approach, these are the inputs. We need the net income, depreciation, capital expenditure, also change in net working capital if you have, the growth rate of the future cash flow. Here again, we will be making our assumption about the growth of the future cash flow, because this helps us out to find the value of the stock in an easy manner. Otherwise, again, if a company is a going concern and there are hundreds of years for which the cash flow will be coming, it is not possible to keep discounting all these cash flows and finite cash flows, right? Because the company, we assume it's a going concern. So if we have a growth rate, we can algebraically use a smaller version of the equation to find the firm value today. So if the discount rate, again, we need tax rate, we need the ratio of debt to equity and the equity beta. And first, from the equity beta, we'll calculate the asset beta, and then that asset beta will be used in the capital asset pricing model to find the discount rate. And that discount rate is K over here, like to find the firm value, is K over here. So we need the very next cash flow. Let's suppose if we are standing right now over here, and this is the end of, say, of 2020, say it's 31st December 2020, then the cash flow which the company will generate by 31st December 2021, that will be used divided by the discount rate minus the growth rate of the cash flow. We can rewrite it as your current cash flow into the 1 plus growth, because the cash flow will grow by a certain rate. This is the assumption we are making, divided by the discount rate minus the growth rate. Now, here is a question. Here we have the situation where the company is not paying any dividend, and the EBIT is 45 million, depreciation is 10 million, and they have a capital expenditure of 3 million. The growth rate of future cash flow is 3%. The tax rate is 35%. Debt to equity ratio is 0.4, and the equity beta is 1.2. And We also have the risk-free rate over here, which is 4%, and market risk premium 7%. So all this data is given to you, right? And we need to find the future. We need to find the firm value using the future free cash flow method. In this situation, if you see, we have a lot more input variables, right? So first of all, we need to we need to have the free cash flow for the next period in order to find the firm's value. So this is our basic formula. Firm's value of the firm, is equal to the free cash flow at the end of the first period. If you are standing right now over here, the timeline is this, that where you are standing right now, that is your time period 0, and by the end of the year it's time period 1. Then the free cash flow is the cash flow which you'll be receiving in the first period. So it should be divided by the discount rate minus the growth rate of the free cash flow. So the free cash flow which you currently have, it has to be multiplied with the 1 plus the growth rate to give you the free cash flow by the end of the first period, divided by the discount rate minus G. So first thing is how to find the current cash flow. So we have all the data. We can find it by multiplying the 45 million, which was our EBIT, into 1 minus the tax rate. This was the formula, if you remember. This was the formula over here. This one, right? So the same thing we are doing over here, plus the depreciation, whatever is the depreciation, minus the capital expenditure, minus the change in the working capital, which is not given over here. So we are assuming over here it's 0. And the free cash flow, the current free cash flow is 36.25 million. So what is your cash flow by the end of the next period? Simply 36.25 million multiplied by 1 plus the growth rate of the free cash flow, which is 3%. So this is how we can get the numerator over here to find of the equation, through which we will be able to find the value of the firm. Now the denominator we have to find as well. We have the growth rate of the free cash flow, which is easily given 3%. So no problem with this, right? But how to find the K? Again, capital asset pricing model. But in this capital asset pricing model, the beta which we'll be using is not the equity beta. It is not this beta, this one, not the equity beta. We can use this in order to find the beta of the asset beta, because asset beta will be using over here in order to find the discount rate for the free cash flow model. Now we have this formula through which we can find the asset beta. We have the equity beta. In the question, we also have the tax rate, and we also have the ratio, debt to equity ratio, right? So it's over here. So if we see this situation, that we have 1.2, because this was the equity beta given to you, and we fed all the values in the formula to find the asset beta, and the asset beta turned out to be 0.95. Remember, this was the debt to equity ratio, this one 0.4 multiplied by 1 minus the tax rate, and tax rate is given 35%. After plugging in the numbers in this formula, we found that asset beta is 0.95. Now this asset beta will be used to find the discount rate, which eventually will be used in finding the value of the firm using free cash flow method. So 4% is the interest-free rate, 0.95 is the asset beta, which we found, multiplied by the market risk premium. So 10 0.65% in decimals. It is written in decimals, but it is actually 10.65%, which is the discount rate. Now this K is now available to use over here, and G we already have 3%. This is the growth rate of the free cash flow, and this the free cash flow by the end of the first period is we can compute over here. So 36.25 was the cash flow right now, and multiplied by 1 plus the growth rate, this one, growth rate, whole divided by the discount rate minus the growth rate. So if you'll solve it, you'll find 488.07 million. If now this is the value of the whole firm, but there is a claim of the debt holders in the firm as well. If 100 million is the debt, then what is the equity value? We know that you will subtract 100 million from 488 million, and you will end up getting 388 million. So this is how we can use the free cash flow to find first the value of the firm, and from that, if we subtract the value of the debt, we will end up getting the value of the equity. I hope you learned in this video how to use the free cash flow method to find the value of the firm. Now remember this thing, that whatever is the outstanding number of shares, you divide this value of the equity value with the total number of outstanding shares, you'll get the stock price of each share. Thank you.